So today's topic that we're going to go over is how to trade earnings properly, right? Because a lot of people love to just swing into earnings um, and really not understand pretty much the gist of what's going on, like what the implied move is for the earnings and the overall underlying implied volatility. So to take a step back, before we actually get into how you should properly trade earnings, first you need to understand what implied volatility is and how it affects you when trading earnings events. Because if you're not familiar with implied volatility, you're basically kind of screwing yourself, because when the implied volatility is very high and juiced and you're not aware of this, you're actually paying more money for your contracts. So this is very, very bad if you are an option buyer, right? So just to kind of compare what implied volatility is and what historical volatility is. So when I say IV, that means implied volatility, right? So IV accounts for expectations for future volatility, right? Which are expressed in option premiums, while HV, historical volatility, measures past trading ranges. Pretty much the way I like to think of it is your historical is your baseline. It's pretty much your average volatility in a sense, right? Over that specific quarter. Because if you look back, it'll make sense in a couple minutes when we review this, but every single quarter's historical volatility for every single stock is different. So historical volatility is basically the baseline, pretty much the average volatility for that specific quarter for that specific stock, right? So this is very important to know up front. And then implied volatility usually will increase during times of uncertainty, right? So what that means is a key event such as earnings, right? We understand that this is uncertain time frames. The market makers love that, right? So they increase the premium, the implied volatility on purpose, right? So when the implied volatility increases, the cost of your contracts also increase, right? So then when the actual earnings event passes and the earnings event is done, what happens is there is no longer any uncertainty in the market. All of the announcements are done, everything is out, all the news is good, right? So there is no need anymore for the implied volatility to be high. So what happens is usually after the earnings event, pretty much the next day, right? So when the actual earnings happens, what happens is the implied volatility goes back to normal, what is known as an IV crush, right? People, you've probably heard this a lot of times in the chat. Oh, I got IV crush, blah, 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 blah. What that means is there is no longer any uncertainty in the market. Therefore, market makers do not need to squeeze the implied volatility higher. Then when the implied volatility goes back to normal, it is then IV crushed. And then also this is when we go back into the option Greeks, right? The Vega. The Vega and the implied volatility go hand in hand, right? It's similar to the delta. You know how for every dollar move, the delta goes up, or every dollar move down, the delta goes down type of thing, right? You know how delta and dollar amounts go hand in hand. That's kind of the same exact mentality with Vega and your implied volatility, right? So when your implied volatility goes back down, therefore your Vega also goes back down and then kills your contract prices, right? So it's very, very important to understand, especially if you are buying extraordinarily higher than normal implied volatility, you are always 100% of the time going to be paying more money for your contract every single time, right? So you don't want to be doing this as an option buyer, right? So for option buyers, you want to be buying when the IV is low, right? When the contracts are a fair value price, and then you want to sell when the IV is high, right? It's very, very important, because oftentimes people don't take their profit when, so let me kind of give a quick example. So run this scenario through your head. It's probably happened to you before. let's just say you're in calls, you think you're in a bullish position, and you see the stock running, right? It's running, it's all, your contract's up a lot, everything's good to go, right? So that's when the IV is high. Lots of people are funneling into that specific option chain. So the IV is getting juiced and juiced and juiced, therefore bringing your premium of your contract up greater and greater. So that is when you want to sell. You want to sell into these prime pops, right? You want to sell into these pops on purpose, because if you don't, your implied volatility will go lower, right? So then your contracts will go pretty much down. So you always want to be selling into the pops, not the pullbacks, because if you ever look at and think and review your charts, let's just say here, let me kind of go to the actual thinkorswim. All right, so can you guys see my screen still for the thinkorswim? Yes, okay, cool, thank you. All right, so let me kind of break that down, what I mean by selling into pops, right? So hold on. Let's just use this as an example. This will be a quick and easy example. So let's just say you enter a call position somewhere in here, right? This is where you want to be selling your call position. This is where you want to be selling for the most bang for your buck, because your option contracts have the best premium, the best option, excuse me, they have the best volatility because of this little spike right here, right? So you want to be selling on the pops to get the most amount of money and the most bang for your buck. If you sell like this, when you get the pullback, you're not going to get much money. So let's just say, for example, right here at the top, let's just say, just a very simple example, you're up $100, right? Just a very simple example. And then let's just say this is even down that low. This is down, let's just say 20 cents. Still really not that much lower, but since you're selling on a pullback, you're not getting that pop. You're not getting that volatility pop. So instead of $100, you're probably selling for maybe 75 bucks, right? So you want to be very, very mindful of always selling into these pops, because that's when the volatility is in your favor, right? You want to be selling at the pops. You don't want to be greedy thinking, oh, and maybe it'll go a little bit higher. Maybe it'll go a little higher. No, just sell into these pops, because you can always get back in on the pullback. There's always a pullback, right? You just have to be mindful and wait for the pullback, but you want to sell into the pops. This goes for both biases. You want to sell into the pops on the downside, and you want to sell into the pops on the upside. You do not want to sell into the pullbacks, because if you sell into the pullbacks, guess what happens? Your contracts aren't worth that much money anymore. You could be selling for $100 up here. You're probably selling for basically nothing down here, right? So don't be greedy and just sell into the pops, right? So that's what I mean about that, okay? So let me then break down implied volatility and historical volatility so it makes a little bit more sense. All right. So if you're on Thinkorswim, there's a cool analyze tab up here. And you go over here, there's an earnings tab. So let's just do Tesla, because Tesla's everyone's favorite, everyone's dick hard for Tesla, right? So the implied one is red, the historical is yellow. So what I mean by that is how the baseline, the average volatility for, let's just say, this quarter was about 55 to 60%. That's the baseline average volatility. That is deemed fair value, right? Whereas once we come into that earnings event, right, you see the uncertain time periods. Look at the implied volatility. It is gradually going higher and higher and going away from the normal, right? The normal at that time period was 55%, whereas right before the earnings date, we were at 83%, right? Now look what happens after the earnings announces. We go from 85% back down to 73%, right? So that's a 12% move implied volatility. Now, if you're not familiar with that, that's 12% of your Vega pretty much. So then you would times this number times 12, and that's how much money you're losing immediately upon open, right? So now this is a 0 DTE contract, so it's not going to be as valuable, but this is usually how the Vega looks, about $60. So let's just say you're losing at least $600 minimum, at the very minimum, on your contract value, just because of this right here. It went down 12% right on top of open. You had no control over that. That is what is known as an IV crush, right? So that's something you need to be aware of, that you're buying inflated premium, and you're buying, it's more money, because let's just say usually Tesla's actual contract values are anywhere from about 2.5 to like $4,000, give or take, right? Now, when they have earnings, they have an extra pretty much $500 or $1,000 on top. So you're basically paying an extra $500 to $1,000 extra dollars on top because you were trying to swing into the earnings, right? So you're basically paying more money, and then you're getting crushed the next day. So why would you do that? You do not want to be doing this for that simple reason, right? So implied volatility pretty much dictates the price of your option contract. And this is why you want to be mindful of it and see if it's fair value or not fair value. Something that would be deemed fair value would be around 60 percentile-ish for this specific quarter. This quarter about 55, this quarter lower, so 35-ish, right? So this is why I mean every single quarter's volatility is different. So you need to be mindful. So this quarter was like, 60%. This quarter was only like 30%, right? So this is something that you want to be mindful of, because you can get crushed. Like, if people think, oh, here's another example that I love to talk about. So I forget exactly which quarter it was last year. It might have been this one. I honestly forget which quarter it was, but I remember people are swinging Tesla overnight thinking, holy shit, Tesla's, gapping up, I'm going to be rich, not realizing, IV crush is a thing. And also it didn't hit the implied move, right? So what do I mean about the implied move? So you have a really handy function that's on for every single chart. So right up here, this is your implied move. So for next earnings event, which is next week for Tesla, you need to, it might change next week. So don't take my word on it for right now. Double check it next week. But currently at this current second, it needs to move at least $6 overnight, either up or down, for you to not get completely crushed. That's the implied move of the earnings event. Whereas let's just say maybe AMD needs to move up or down at least $1. And now obviously things can change. Earnings events are not for another 2 weeks for this, but you kind of get the picture. You can see this beforehand. Hey, how much is it supposed to move for me not to get completely IV crushed, right? So kind of keep that in mind as well. So then that takes me to my next point of, okay, Scrub, if I don't swing overnight into earnings, how do I play earnings? So I'll give you two really great examples. So let's do Tesla first, since we were talking about that. So I mapped it out. This was last year. So usually this happens very, very often. So you have an earnings run up. You have the rebalancing state, basically a selling off, a little bit of a rebalancing state. Then you have a continuation. This happens very, very often. If you go back, most of the charts that you play earnings with do the exact same thing. So here's the earnings event on October 20th. As soon as we come into that earnings event, we had a sell-off, right? So people are trying to buy calls and they got shit on, right? So then here's the rebalancing state. We actually found a new support level. The next day we found support, and then pretty much continued higher, right? So here's the earnings date on October, and here's when we came into October. This is known as the pre-earnings run-up. So you want to be playing and positioning yourself to either of these sides. If you miss the run-up, wait for the continuation, right? Because why do I say that? Implied volatility. Your implied volatility is lower over here and after the event, right? Your implied volatility starts to get really juiced pretty much right here, right before the earnings event. This is when the market makers really juice your premium value and you get a shit deal, right? So you want to be playing pretty much right here, the run up, because you just got easily, 50 points. I mean, if you did the entire thing, this is $100 move. Now, I'm not going to say it's a perfect scenario. You're going to hit $100 every single time. But even if you day trade this or swung some of this, you still could have got a fair bit of a move, right? So then here's the pre-run up. Then here's the pre-pop. Usually a couple days before the earnings event, you get a nice little pop, a very aggressive pop. Then you get the rebalancing state. Then what happens? You get the huge fucking continuation, right? Huge continuation. And your implied volatility is a lot less. You're not spending a shit ton of money for your contracts, so you're getting a huge continuation. This was what, $300 some dollars? I'm not saying you're going to catch this entire move, but even if you caught a quarter of this move, this is a lot of money for your trading account, right? So this type of stuff happens very, very, very often. You get the run up when we come into the earnings month. You get the really aggressive pop before the earnings event. You get the rebalancing state. Then you get the continuation, right? So let's do another example. So let's do AMD. AMD is another one, right? So here is earnings event on last year, October. Here's when we came into October. We start having a nice little run up, right? Nice big old run up here. Then we have that tiny little bit of an aggressive pop right before the earnings event. Then we get the rebalancing period. Now, this is something to be aware of. You might not get the rebalancing period the next day. It might not be immediately. In this case, it took a couple days of consolidation and rebalancing to get that next move higher, right? So this is something very, very important to think about, because if you think about it, we did just run, almost 25, 30 points. Clearly, people are going to be taking their profits. They want to be, this is where the consolidation happens. This is a good thing. You want to see consolidation like this above the key levels right here to get the next move higher, right? So this is the exact same scenario. We get a run up during the earnings month. We get the aggressive buying right before the earnings event. We get the rebalancing state. Then we get that huge, huge continuation, right? Now, if you understand this, you could be, making a fair bit of money. You could be either day trading these moves, or you could be swinging like 2 or 3 weeks out for these moves, because you could have caught potentially, a $20 move here and a $20 move here, knowing the simple tip of just, hey, don't play the earnings swing overnight, play either the run up or the continuation, because I know in the back of my head, okay, I'm not going to get IV crushed this way and my contracts will be cheaper, right? So then now here leads me to my next point. These run ups don't have to happen every single time. Here's an example where it does not happen. So here's the earnings month. We're in July, right? So when we come into it, we have a tiny, like a tiny pop, right? Excuse me, we have a tiny pop, but then this is all-time high at that specific time period, $95. So we find a ceiling. We basically kind of stay range bound for a bit, right? Kind of stay range bound. Then we get that tiny little bit of a pre-earnings pop, the aggressive pop before the earnings rebalancing period, which was right here. Now, this one didn't consolidate. This one just popped the next day, right? It just popped the next goddamn day, right? So this is something you want to be aware of. It doesn't 100% of the time have to be pre-earnings run-ups, and it doesn't 100% of the time have to consolidate a couple of days after. It can just pop immediately, right? So these type of scenarios happen very, very, very often. You get run-ups, you get pre-pops, you get rebalancing periods, people taking their profits, and then you get a massive continuation either to the upside or to the downside, depending on, you know, how the stock is at that given time point. But either way, you can get you can capitalize on either direction, either bullish or bearish, right? Because as option traders, we don't give a shit what the price is doing. We just go where the, you know, where the money is going. So those are a couple of different examples of how to actually play earnings events. Now, another thing I'd like to talk about, AMD, if you kind of look here, this is something you don't want to be sleeping on soon, because if you look, so AMD, if you look at the pattern, kind of like the exact same thing, we had a sell-off, consolidation, sell-off, and then here's the earnings. We're coming into earnings, exact same thing, right? So as option traders, we're able to capitalize on this, right? So what I mean by that is, if you're not seeing the picture, there's only two ways that can happen right here. We can fall from this flag and go back down to like 90 bucks. And then potentially when the earnings happens, go right back up, or go right back down. Or we actually can hold at $95, and during the earnings, we can do something like this. We can just pop right back up. All right. So this is very important, just to kind of review past earnings events for a specific stock that you want to trade. So definitely keep AMD on watch for the next couple of weeks, because it can be a very violent move to the upside or a very violent move to the downside, then the upside. So either way, you're going to be able to make money. But anyway, that's kind of my quick and easy spiel of how to play earnings and the importance of pretty much not swinging overnight, because you're paying more money for your contract because of the IV increased. And then when the IV, you know, decreases, and it crushes you and your contract value. Do you guys have any questions about this? Please put them in the chat. If you want to talk about anything, we'll happily talk about some stuff. Anything at all. If you have any questions, anything you want me to review, whatever you want to talk about. Alrighty then. So you don't recommend small accounts to swing. Are we talking swinging into earnings? Or are we just talking about swing in general? Oh no, you could definitely swing. By all means, you could swing, right? But I'm just saying you do not want to swing earnings overnight, especially if you're a small account, because that's basically borderline gambling. Like earnings events are literally 50-50 shots every single time. You can potentially win big if you're lucky, or you could potentially just, the option contract goes to zero, right? Swinging in general is not bad if you're a small account. It's usually pretty good for growth. You just have to understand a correct market environment to do it in, and buy enough time. You want to ideally buy at least 2 weeks of expiration when swing trading. If you can't afford that, that stock's not for you. Or you could be trying to open swing trades with debit spreads, basically opening spreads. I have a video on that here. I'll link it in the chat if you want to check it out. One sec. But that's an entirely different topic that I already did a video on that. If you want to check it out, it's basically called spread trading, which is very, very valuable for smaller account people. Here you go. I put it in the chat for you. Hold on, let me check out some other questions real quick. Is there any way to know which way it's going to go? I mean, not really. Honestly, no, not really. You could potentially check the flow and, you know, like where big money is positioning themselves. But like if someone tells you 100% that this stock's going to do this, they're pretty much full of shit, because no retail trader actually really knows where the hell it's going to go. Like, yeah, we could make, you know, scenarios like X scenario, Y scenario, Z scenario, just to have all these different scenarios in the back of our head, but we don't actually 100% know where the hell something's going to go. Can you review the impact of IV crush on a contract? I kind of did that already, but pretty much. So let me kind of just review it real quick one more time. So what would happen is, let's just say let's just do really quick and easy example for this one. Let's just say 30% decay, really easy example. So let's just, actually, let's do 25%. So 25%. So let's just say you bought the contract right before the earnings event, right? And you bought it at 50% implied volatility, and then it goes down, let's just say 10%, right? So what happens is when your implied volatility goes down 10%, then you have to incorporate your Vega into it. Your Vega will be important right here, because when your implied volatility goes down, so does your Vega. So then you would basically take 10, so basically 10% times 6. So immediately upon opening, you're losing $60 alone just because of the IV crush. Now, that's only with your Vega. What happens with your Delta and your Theta, right? You have to incorporate these too, because if you're swinging, let's just say that's $20. So you're already opening $60 down for the IV crush, $20 down because of the Theta. So right there on open, you're already losing $80, right? And let's just say the stock didn't go in your direction and went down another $1. So you're losing even more money because of your Delta, right? So you have to incorporate all these different Greek factors into that. It's not just because, hey, I got IV crash. It's literally the Vega coming into effect. It's your Theta coming into effect. It's your Delta coming into effect, right? It's all these different things. They all go hand in hand. Does that make sense? What is the time horizon for swinging AK? Hold on, let me just 1 sec. Okay, good. I'm glad it makes sense. All right. So next question is, what is your time horizon for swing trading? AKA, if you want to swing an option for approximately 2 weeks, would you buy 6 weeks out? Yeah, that's a great question. So usually, if I think the move is going to take 2 weeks, I'm going to purposely buy more time to give myself a cushion. Purposely, I'm going to buy more time. So let's just say I think the move is going to be 2 weeks. I would buy 4 weeks minimum, right? If I think the move is going to take 1 week, I will buy 2 weeks minimum, right? If I think the move is going to take a month, I'll buy a month and a half or 2 months, right? I'm going to always buy more time just in case something happens overnight that is out of my control. So when swing trading, it's always good to buy time. Do you change how you use stop losses through earnings? Are you talking about swinging earnings overnight, or what do you mean exactly, Brian? Oh, okay. When you buy time, when do you know it's time to cut because you're losing? So that's a good question as well. So the question, just to reiterate, is when you buy time, when do you know it's time to cut because you're losing? So if your thesis is invalidated, so let's just say, quickly, let's just say I'm gonna swing AMD calls, right? Here's my invalidation zone. It's the moment it comes underneath this swing low. So basically, the moment it comes under like $94, I know I'm invalidated. I have to cut, right? So you just need to have these theses in your mind. So like, if this happens, I have to get out, right? So in this case, if I'm swinging in this general time period for calls, I know underneath this swing low, basically $94, I need to cut, right? Or you would need to have like a general guideline in your mind, like, okay, I'm going to cut at, 40% stop loss, maybe, 30, 40, 50% stop loss. You don't want to be holding your swings for more than 50%, right? So when swing trading, you have to be okay with having a tighter stop loss, or excuse me, a wider stop loss, because, stocks, you need to let the stocks breathe in a sense, right? So having a wider stop loss when swing trading is very important. Next question is, so do you consider same support and resistances on either side of earnings report? Yeah, pretty much. You have to, use really hard support and resistance lines. So like every single support and resistance lines I charted here were basically one's either an all-time high level or a very strong bounce level. So like if you look here, this one's from what, almost 8 months ago right here, was an all-time high level. Look where we're at right here. So if this level holds, this could be a very good buy the dip, right? Or if it doesn't hold, we're going to go back down to here, about 90 bucks. That's where we're going to go next. Do you think it's a bad idea to swing 3 to 6 months out, or even more? No, it's not a bad idea at all. You're basically trying to buy time horizon. Now you have to have a good, thesis. You can't just buy 6 months just to buy 6 months. It has to, your technicals have to line up. The sector rotation has to line up. Like all these different criteria have to line up. But if you get like good stocks to actually buy, like for example, like if AMD consolidates around this general region down here and holds, this will be a fantastic time to buy 3, 6, maybe 12 months out expiration for calls, and then target like somewhere up here, right? Because this is where the next consolidation periods were. So just you can buy time for that and pretty much just kind of buy time and forget about it type of thing. But I wouldn't really recommend having a 70% stop loss. That's pretty wide. I try to just cut your losers at like 50%, unless you think, okay, there's a huge hard support here or huge resistance here or whatever bias you are, then maybe give it a couple more room, but don't let it just go to 99%, right? That's because that 99% stop loss will be hard to go back to break even. Make sense? Awesome. So I'm going to end the session here today, guys. If you guys have any more questions, feel free to just at me in the chat. I really, really appreciate you guys for listening. I hope you have a fantastic Easter. And also, if you guys haven't seen that I post newsletters every week, I post these every Sunday, just basically going over lots of market sentiment, lots of analysis. If you want to check it out, let me know. I'm going to have an Easter special. Just do a little discount for people. I have over a 90% win ratio every single week. So I appreciate you guys for listening. Thank you again. Have a safe and enjoyable holiday.